Let's clear something up right away. You do not need a screen covered in 50 neon lines to be a successful trader. In fact, that clutter is probably holding you back. In the Forex market, the raw price action already reflects every piece of available information. By the time a complex lagging indicator flashes a signal, the move has often already happened. Over the next 5 minutes, we are going to build your personal trade book, a physical, structured plan to trade pure price action, backed by strict mathematical risk management. So pull up your Forex demo account and grab a blank physical notepad. We are going to write this down together. Writing down your strategy stops you from guessing and reacting to noise. It is the exact step that shifts your trading from a casino habit into a resilient, manageable business. Step 1 is a clean slate. Go into your charting software and delete every moving average, RSI, or MACD you have applied to the screen. This chart shows exactly what we're left with, a professional, clean candlestick chart displaying nothing but price. This approach is called price action. We rely strictly on how the price has historically moved, paired with trading volume, to map out where the market is likely headed next. Look closely at your chart and identify the pivot points. Find the lowest dips, which we call swing lows, and the highest peaks, known as swing highs. Connect those swing lows with a straight line to get an upward trend line, a support floor where buyers step in. Connecting the swing highs creates a downward trend line, a resistance ceiling where sellers push the price back down. As long as the price stays between these structural lines, the trend remains intact. By marking these boundaries, you turn a chaotic market into a highly readable map. Structural lines only tell you where the boundaries are. To actually risk capital, you must wait for a specific pattern to trigger. Write this down in your trade book. Setup number 1, the breakout. This chart illustrates the exact moment of a breakout. Watch the green candlestick. It decisively pierces straight through that downward resistance ceiling, signaling that buyers have taken control and a new bullish move is starting. But here is a critical warning. A price break alone isn't enough. If it happens on low volume, it's a false alarm that will trap you. To confirm the setup, look at the volume bars. You must see a distinct spike at the exact moment the price breaks resistance, proving institutions are backing the move. Setup 2, the bull flag. A steep upward price surge forms the flagpole. Then the price drifts lower inside a tight channel, the flag. Be patient. Wait for the exact moment the price breaks out of that pause and resumes its vertical climb. Knowing these 2 verifiable setups changes your entire approach. Instead of randomly guessing and chasing price movements, you sit back and wait for the market to come to your defined targets. Now turn to a fresh page in your trade book and title it Survival Rules. These are non-negotiable. Rule 1. Never risk more than 1 to 2% of your total account capital on any single trade. It does not matter how perfect the setup looks, you strictly limit your exposure. Rule 2. Always set a hard stop loss the moment you enter the trade. This automatically cuts your position if the market moves against you, preventing a small loss from compounding. Do not fall into the psychological trap of moving your stop loss or throwing more money at a losing trade in the hope that it bounces back. If the trade hits your stop, accept the tiny loss and walk away. Rule 3. Always maintain a minimum 1 to 2 risk-to-reward ratio on every setup you take. This visual shows exactly how that math works. If your stop loss is set to risk exactly $100, your take profit target must be set to capture at least $200. This ratio gives you a massive mathematical advantage. With a 1 to 2 setup, you can lose 50% of your trades over a month and still walk away highly profitable. A brilliant strategy without risk control will fail. Strict mathematical parameters are the only structural difference between the trader who zeroes out their account and the professional who survives long-term. Take a look at the physical notepad in front of you. You now hold a fully actionable trade book. You have a plan built on clean price action, specific volume-backed setups, and a non-negotiable 1 to 2 risk ratio. Now take this written strategy into your Forex demo account and execute 50 to 100 simulated trades. This simulated phase is mandatory. It is the only way to calculate your actual win rate and verify your edge before you put a single dollar of real capital on the line. The market will test your patience, but sticking to your written rules, managing your risk mathematically, and leaving your emotions completely out of the equation is how you survive and thrive in Forex trading.